All right, today we're going to pull back the curtain on a brilliant, kind of sneaky billion-dollar strategy that's hiding in plain sight. It's a story about two of the most popular funds on the market and how one of them is secretly costing some investors a small fortune.
I mean, think about that for a second. Why would any company do that? It sounds kind of crazy, right? But that is exactly what the investment giant Invesco did with one of the most traded funds in the entire world. And the answer? Well, it reveals a pretty ingenious business strategy.
You see, the story behind these two ETFs, QQQ and QQQM, is this fascinating case study. It's all about corporate moves, investor psychology, and how a little bit of old financial plumbing can end up costing you a lot of money if you're not paying close attention.
So, at first glance, these two look like identical twins. I mean, they both track the exact same thing, the 100 biggest companies on the Nasdaq, your Apples, your Microsofts. But then, you look at the price tag. QQM is noticeably cheaper. And that single difference, well, that's the first thread we're going to pull to unravel this whole mystery.
To really get what's going on here, we have to hop in the time machine and go way back. It all starts with the original fund, the famous QQQ, and some, let's say, design flaws hidden deep in its DNA.
So QQQ was born back in March of '99, right at the peak of the dot-com excitement. But here's the crucial detail, the thing most people miss. It's all about its legal structure. It wasn't built like a modern fund. It was created as this thing called a unit investment trust, which is basically a financial fossil from a totally different era. Okay, so this UIT structure is based on a law all the way from 1940. Think of it like a frozen basket of stocks. It was designed to be super simple and unchangeable. But that rigidity, that thing that was once seen as a good thing, it's become a major problem. It creates what we can call the UIT trap.
And here's what that trap really means for performance. Unlike pretty much any modern fund, QQQ can't just take the dividends it gets from companies and reinvest them right away. That cash just sits there, doing nothing, which creates a cash drag. And get this, it's also legally forbidden from lending out its shares to make a little extra income. Oh, and the weirdest part? It actually has a legal expiration date. It's just a less efficient product by modern standards.
So you're probably thinking the logical thing, right? If your main product has these known issues, why on earth wouldn't you just fix it, update it? Well, the answer boils down to two incredibly powerful forces: a ridiculous amount of trading volume and a whole lot of money.
Let's just put a number on it. $100 million. That's roughly how much money in annual fees Invesco would have just, poof, evaporated if they'd simply lowered the price on the original QQQ. They were making way too much cash to just flip a switch.
And here's the other piece of the puzzle. For big-time professional traders, QQQ isn't just a fund. It's a tool. It's like a financial superhighway. Hedge funds, big institutions, they pump billions of dollars through it every single day. For them, the ability to get in and out of a massive trade in a split second, that liquidity, is way more important than saving a tiny fraction on a fee.
So you can see the bind Invesco was in. They couldn't really change QQQ without angering their biggest customers and losing a boatload of cash. But at the same time, new investors were choosing cheaper competitors. Their solution was brilliant. If you can't fix the old thing, just build a brand new, better one right next to it. And that's where QQQM comes in. The M here pretty much stands for modern. They designed it from a clean sheet of paper to fix every single one of QQQ's old-school problems. It can reinvest dividends, it can lend securities for extra income, and most importantly, it's offered at a much more competitive price. And this, right here, is Invesco's master plan. What they did was create two separate doors that both lead into the exact same investment, the Nasdaq 100. So door number 1, QQQ, is for the big institutional traders who need that liquidity and don't care about the slightly higher fee. Door number 2, QQM, is for all the new, cost-conscious investors. And what about everyone else? Well, Invesco profits from something we can call the inertia tax. See, they know that millions of people have owned QQQ for years and have massive gains built up. To sell it and buy the cheaper version would mean a huge tax bill. So what do most people do? Nothing. They stay put, and they keep paying that higher fee year after year.
Okay, so let's get to the bottom line. What does all this actually mean for your money? I mean, we're talking about a difference of 0.05%. Does a number that small really even matter in the long run?
Oh, it matters. Let's run the numbers. Let's say you invested $100,000 and just let it grow at 10% a year for 30 years. If you were in QQQ, that higher fee would leave you with about $1.64 million. Not bad. But if you were in the cheaper QQM, you'd have over 1.66 million. That's the difference, $23,000. Over the long haul, that tiny little fee difference quietly eats away an amount of money that could buy you a brand new car. That, right there, is the price of loyalty, or the price of inertia.
So, now that we've pulled back the curtain and figured out the whole strategy, we get to the final and most important question. Which one of these funds is actually the right one for you?
You know, the good news is the choice is actually super simple. If you're a day trader, an options seller, or a massive institution that needs to trade huge blocks of shares in a nanosecond, then yeah, QQQ's liquidity is worth the price. But for pretty much everybody else, for anyone who is a long-term, buy and hold, set it and forget it type of investor, QQQM is just, well, it's the better and cheaper product.
You see, this whole story is about more than just a couple of ticker symbols. It's a perfect example of how understanding the structure behind a product can be just as important as knowing what's actually inside it. It proves that sometimes the most expensive mistake you can make in investing is just doing nothing at all. Which kind of makes you wonder, right? What other little illusions, these hidden inertia taxes, might be hiding in plain sight in your own portfolio?